So many of you might be interested in how do you get into real estate, and especially in the crazy times that we are in now in 2022. And in today's episode, we're going to be discussing exactly that 12 different ways to get into real estate. So let's do this. Before we get started, I do want to go ahead and pick last week's winner for participating in the shows. As you know, in order to win prizes, you do need to subscribe, like, and put in a comment, which I actually do look at them and often reply as well. And last week we did Danger Ahead, and the winner is Yoon Hong. So, dude, if you are watching, you have 1 week to reach out and contact me, and you can do that the best by reaching out to onedealaway.com/contact. I will put it in the show notes as well. So in the email, when you reach out, make sure you put in the email that you use for YouTube, and I will be making sure to reach back and put you in. And congratulations, you have actually won a digital version of my best-selling book, From Financially Stressed to Money Blast: How to Retire Early at Any Age. So there you go. You just won a book. So congratulations. And I look forward to receiving an email contact from you, confirmation, so that I can get you in and send you that book. All right. And as promised, we're going to be discussing 12 different ways to get into real estate and get into real estate relatively quickly, relatively easily, relatively speaking fast. So we're going to be talking about different ways that you can do this. And I have come up with about 12 different ways. Some of them are broken down. We're going to talk about the best and the worst, the easiest, the most difficult. So let's get started. Why don't we just get started with it? So first part, how I broke it down in chunks, is no to limited ownership and no management of it. I'm going to talk a little bit about management as well. So number one is going to be mutual funds. They're pretty easy. You can do them from your IRA, but they give you no ownership, and there's potentially some challenges with it that we're going to talk about. REITs, real estate investment trusts, again, you can buy them on the stock markets. Real estate company stocks, for example, Open Door or Zillow or that kind of stuff, where they're invested in real estate that you can get into it. Real estate shares, so that's investing in things like Fundrise, or if you're a crypto lover, in Proppy, where you get portion of it, where you put, $50, $100, and you get a small percentage of particular property and benefit on the property shares. And then we have syndication, which that's the part of the limited ownership. Syndication is similar to real estate shares, minus the whole piece of you actually have to put in a much larger chunk of money, and there are less owners. So in real estate shares, like a Fundrise, there could be millions of different owners that can participate in a portion of it. In syndication, you're putting anywhere between $25,000 on the low end to hundred, sometimes two, three, four, $500,000 into a project, and you become partial ownership. And typically with syndication, you get much better and higher returns, but it also takes much more money to get in, and there's no management involved because the syndicators themselves will typically manage the property. Some of these are liquid, for example, the mutual fund, REITs, the real estate company stock. Those are going to be very, very liquid. You can go on places like even Robinhood, buy, sell. It's fairly easy to do. Real estate shares are also fairly easy to do. Syndication is easy, but it's not as liquid. Depending on the syndicator and how things are being set up, you might have to hold for 3 to 5 years, sometimes 7 to 10 years. Your ability to sell and get out might be somewhat limited because it's not on public, it's not publicly owned. So typically they have to evaluate their investors because projects typically have smaller number of individuals. It could be 2, 3, 4, 5, 10, 20 people max. They typically like to have a smaller group of folks that are involved with projects. So now we're going to switch on to the full to partial ownership, and you'll see what I mean with partial. Timeshare. I have a lot of opinions on timeshare, but it is a way, and a way that typically folks that are not as educated on real estate like to get in, because you pay all this money and you get a week at these different locations that are typically higher luxury and people enjoy it. And it's sort of like getting a hotel for a week at a different location, but locations are very specific and weeks are very specific. And these are a heck to get out of. They typically cost a whole lot of money, so they landed on my worst to participate list. And we're going to talk about that in a few moments. The next one is going to be primary residence, no hacking. So that basically means you buy a condo, you buy a house, you and your family live in it, and that's that. And you basically participate in hopefully appreciation of the property prices. This is what vast majority of individuals who are in real estate actually do. Then we have primary residence with house hacking. And what is that? Well, that basically means that you are renting portions that you are not using within your house. So empty rooms. So say that you are a single person and you have a 5-bedroom, 4-bathroom house. You live in the house, you sleep in one bedroom, use one bathroom, but you have all these other bedrooms and bathrooms. You end up renting these bedrooms with bathrooms, of course, to different individuals. And it could be a very good and lucrative way to get into real estate and investing in many ways. The other options are, say that you have a huge backyard and you basically rent it out to parties or weddings or whatever, a barn, a parking lot, whatever that you might have that you can rent for different events. Again, typically when we talk about backyards and barns and parking, that kind of stuff, your property is going to be probably very, very large. You might have, say, for example, a farm where you maybe farm on a part of it, but maybe you lease the rest of it to somebody else who's going to farm it, and they pay you for the rights to do that. So those are house hacking different techniques. Multifamily residence and rental. So this is where you purchase 1 to 4 unit. Well, if it's multifamily, it's going to be at least 2 units, I guess. So way to go, Nev. So 2 to 4 unit rental property. The financing works exactly as if you were to purchase a single family home, but you end up having an additional 1 to 3 units that you end up renting. Now, these could be long-term rentals, meaning you rent it for a year, right? You write a contract and somebody moves in and they live for a year, and maybe you renew it next year, they move out, somebody else moves in. Or it could be a short-term rental where you run something like Airbnb out of the vacant unit. Now, of course, you can have a separate rental property to do both long and short-term. Well, you can't do it at exactly the same time at the same unit, but you know what I mean. So you buy a condo that you rent out, or single-family home, or even multifamily residence that you end up renting out. Large commercial property is another way to get into it. So this is when we get into apartment buildings. So 5 units and up is going to be considered commercial. You're going to need to commercial lending, commercial process to do all of that. But those are going to be apartments. Mixed use properties, say that it's maybe 3 units of rental and 2 units that are retail only, office space, parking lots, industrial complexes, campgrounds. So there's a vast amount of what you can do. Hotels, motels can also work the same thing. And then, of course, you have flips, which is you buy a property, you do something to it, sometimes you don't, and you flip it for more money than what you purchased it for, and more money than you purchased and had to do something to, of course, add value to it. So the goal with flips is that if I buy a property for $100,000 and I put $50,000 worth of improvements to it, I would want to sell it for, say, $180,000 or $200,000 or more. The goal is with flips to sell it for more than the cost that it took you. Now, of course, the interesting piece that you can do with flips is when you buy a property and you improve it, then you can flip and refinance and then turn it into one of the rentals. So those are different ways, 12 different ways that I could come up with when it comes to properties and how do you get into real estate. So first one was predominantly on paper. You own some sort of paper asset that benefits from the property or the company that owns the property. And then the second way is where you actually own property, whether partially or fully. Timeshares are, as I have shared, the worst piece that you can do, and I cannot recommend it to anybody under the sun. Not that I would be able to recommend anything to anybody, because I'm not a financial advisor and I cannot recommend anything. But you couldn't pay me to get into one of those. Let's just put it that way. And I like to be paid. I really like to be paid, but you couldn't pay me to get into a timeshare space at all whatsoever. So these are the different ways. Now, some of these with primary residence, multifamily, and so on, management may need to play a part. So you can self-manage the properties, meaning you are the person that they call when something doesn't work. You are the person that collects the rent. You are the person that looks at potential renters of who's going to come in, who's not. You can also outsource the management to a company or to a person. You can outsource all of it, and they do everything from leasing to collecting the rent to dealing with the calls to getting all the different contractors and vendors to come and maintain the unit. And that typically ends up costing a bit more, but it does give you a whole lot more time. Or you can actually manage it yourself, which means that you basically get to keep a portion that you would give to a management company. Again, it depends on your time, it depends on your money, it depends on the location of where you are and where the properties are. Some are easier to manage. I would say that it's much easier to manage something that is relatively close by. So if I live in a same town where my property is located, then it might be easier for me to go out there and show the place and get different vendors to into the property to fix it and do whatever that needs to be done. Or if I'm handy, then I end up doing the whole thing myself or part of the things myself. If I live in New York City, but my property is in Los Angeles, it's going to be much harder for me to go out to Los Angeles and show the property. So in that instance, I might get a rental agency or a property management agency or professional to go and lease the space, and maybe they deal with all of the calls and stuff, or maybe I deal with some of the calls but they just lease. So you can do whatever you want. It's very flexible and it can be very, very creative, which is part that it makes it kind of interesting for real estate and why I really enjoy it. So worst ways to get into it, in my humble opinion, timeshare is in number one spot because you can't sell it. Well, you can, but it's really, really difficult to get out of it, which is why you see the amalgam of attorneys that come out there and basically help you get out of timeshare. So it's very hard. Mutual funds, I have done different talks and opinions about mutual funds and why I don't like them. Typically, I don't like them because you put all of the money, you take all of the risk, and you only take about 30% of the money that comes their way. There's a lot of taxations, but of course, it makes it easy to put into your retirement, which I would never put a property into retirement because of the tax implications or the tax benefits that real estate provides us when we participate in it. REITs, again, similar to mutual funds, easy to get in, easy to get out, but you don't have any control over it. And as an investor, I actually like having control over my assets because then I can do something about it. Stocks, again, I don't have anything against stocks, but again, you can't control what happens. Say that you are investor in Zillow and Zillow was buying stuff and doing all the great, and then they, a few months ago were like, oh no, what we were trying to do is not working, so they sell everything, and of course their stock goes down. You can't control any of those things, so that's the reason why I don't like it. Shares, again, similar to syndication and shares, is that especially with shares, you basically have zero voting rights. So you get what you get. If the management of the company is not as great and they're not getting as much money, or the property is having some challenges and issues and it costs more, there's nothing you can do about it and there's no votes that you can have. Syndication comes in, and syndication is actually not bad at all. It's very easy, but you do have to have a lot of money to get in, and it's not something that you can necessarily like finance or borrow against, and so there's limitations there. But the benefit is that you typically get to participate in some really great projects, and you do get they offer anywhere from about 5% to 10%, 12% if you're really lucky, return on your investment, which could be a really great way to get into some passive investment where you are able to sort of co-own the property, but you don't have to do much of the management. Primary residence also shows up here in the worst way. It's not a bad way whatsoever, but when there's no hacking, there's no money coming in, so you basically have a liability, and your only hope that you can make some money from it is that the price will appreciate, and that at some point in the future you can sell it for more money than you purchased and be able to make some money that way. But the unfortunate piece is that you still have a place to live even after that. So that's sort of a Robert Kiyosaki way of saying getting back into the rat race. So I'm not crazy about it, but it's not necessarily a bad way. Short-term rentals are showing up on this list mostly because of the tax implications and the labor involved. You do make a nice chunk of change, especially if the property is in a very popular area and it's easy to manage. You have a good crew that can come in and clean. You get great people that respect your property, which doesn't always happen, but most of the time it does. So you can make a nice chunk of change, but do be prepared that you're going to be taxed at a much, much higher rate, which is the reason why it's showing up here. And then flips show up again because of the labor, because of the cost, because of the tax implications. But again, they can be very lucrative way, especially if you do it the right way. And the right way for me, in my humble opinion, is the way to actually purchase a property for way, way, way under the price, and then potentially not even have to fix it, flip it as is for way more. So that reduces on the cost out, that reduces on the labor, and now I can just flip it and be able to get money out and rinse and repeat the process. So flips are more of a active business than they would be otherwise, so they're taxed as such. So something to pay attention to. The best ways, in my humble opinion, are going to be long-term rentals, including house hacking. And the reason for that is that you're not participating in gaining only on the appreciation of the property, but you're also getting passive income on an ongoing basis. And if you can structure it in such a way where you're having multiple rentals, multiple properties, multiple ways to make money from it, then you're able to hopefully potentially protect yourself. But it does come with the risk, of course, that you can rent it. And we've seen it with the pandemic where some individuals couldn't pay for the rent, and now you're stuck with having a tenant. You can't evict them, but they're not paying. So there are risks involved with that, and you need to be aware of it. Short-term rental shows up again. Not that it's bad whatsoever. It is really a great way. And but the tax implication, and again, if we're going to talk about pandemic and nobody travels and so on, we did see that many individuals who own short-term rentals were basically sitting on properties that they couldn't make any money off of. So that was a risk. And then, of course, flips. Again, I know it's counterproductive or counterintuitive that I'm sharing that flips could be bad, but they can actually be really, really good. Again, if you do it the proper way, where you put just a little bit of money in to be able to get the property, and then you flip it at the market rate or slightly even below, where you can still make multiples on your money. That is a great way to get into real estate and make money from it. Syndication, again, showed up on the not so great way, but it is a good way. And as you can see, we're kind of going down and meeting with some of the different ones that were on the worst way. Syndication is pretty good because you don't have to manage it, because you don't have to do much of anything, because you do get checks on a regular basis, and you have more or less set way of doing things. And one of the pieces that I did not mention that we should talk about, one of the ways that I did not mention that we should definitely talk about is lending. So one of the ways that I did not put on the darn thing, so that will make it 13 ways, or this is the bonus way, is lending. So as a private lender, you can actually rent money out to a developer, to an investor, where they would basically pay you as if you were a bank. Now, the challenging piece is that there are many nuances that you need to understand and ways to do it, but you basically become a hard money lender where you have cash and you lease that cash to an investor. So say that you're a private lender, say that I'm an investor, we get into a contract, you give me $30,000 on a property that I'm going to buy and I'm going to improve, and then I'm going to flip 6 months from now. So in the meantime, I'm paying you interest, whatever we agreed on. You are getting money during that time. And then when I sell, I actually pay you whatever I borrow from you plus whatever interest was owed to you. So there's different ways to structure it, but that is one of the ways to do it. There are risks, of course, involved with it, but the nice part is there are risks, of course, involved with it, but the nice part is that if you have some cash laying around and you don't want to invest in stocks or REITs or mutual funds or shares or syndication or anything like that, because you want to have better control over your money, then potentially being a lender within the real estate could be a great way. Thank you for watching. If you've learned something in this episode, make sure you like, subscribe, hit bell notifications. Make sure you put in the comments if you want to be put in for drawing to win some of the cool prizes, including but not limited to merch, educational materials, including courses.